the dollar as a measurement continues, but how the dollar moves from physical form to digital form in your bank account to your private wallet in the Web3 format, where it's much more diversify, more competitive. And I think there is a space race on what the new format of money will be and whether the dollar will still dominate in the world.
I think that the dollar is still going to be the main denomination of trade and investments, etc. As a Singaporean investor, if you want to be invested in diversified bonds, then you're taking currency risk.
Okay, welcome back to the Financial Coconut Podcast. I'm your host, Reggie, aka your Chief Financial Coconut, and I'm joined with great guests. For our audience that don't know you, would you like to introduce yourself?
Well, first, thanks for having me again. My name is Yam Kee, and I run the business for Circle here in Asia. Circle is a fintech company that issues the digital dollar and builds a payments network on top of that.
Yeah, that's why you should be here, because we're here to talk about the future of the US dollar, right? So Yam Kee and Steve.
My name is Steve Bryce. So I'm the Global Chief Investment Officer of Standard Chartered Bank based here in Singapore, but running the business across both advisory and discretionary portfolio management for the bank.
So what do you do as the Chief Investment Officer?
Advising clients on the outlook for financial markets, asset allocation decisions, portfolio investments that people might consider or might want to take into account. And then obviously managing money on behalf of clients as well. So by either the advisory or the actual portfolio management route. So across retail and private bank.
So I'm sure you have a lot to say, right, about today's topic.
If I didn't, I probably wouldn't be in this job, yes.
Great. So and I mean, I'm very happy to be doing this episode together with Circle, right? Because this is an important episode, right? It's a talk of the town. I think a lot of people are concerned about this. Anybody that's tuned in would really wonder what's next, what's to come, right? And everybody on the internet is saying all sorts of stuff. So it's great to have you guys here to kind of clarify, where do we think is the future of the US dollar? What's happening? What are the forces at play, so that we can give our audience some clarity of the situation, right? So maybe for a start, kind of lay down the ground for us. Like, what is your optics? How are you looking at this thing? Where does the US dollar stand?
Okay, so I guess obviously this is in the following on from the US election, right? I think we have to start there. So the dollar has been strong for quite a long period of time, right? So if you look at it on a valuation perspective, the dollar's already before the election was quite elevated, whether you're looking at trade weighted on a real basis or on a nominal basis. So, but obviously we've seen the dollar rally quite strongly since the election. And that's on this view that we'll get a fiscal stimulus that's going to basically push up the probabilities of either no landing or soft landing scenarios. So they're reducing the risk of a hard landing scenario. That might make the Fed a little less accommodative. We still expect them to cut interest rates. I'm sure we'll get into this a bit more in the future, but a little less accommodative maybe than the European Central Bank. And also we're going to get tariffs coming through. Now, obviously the exact shape and form of those is up for very much debate. We've spoken very recently about whether that's 20% tariffs on Mexico and Canada or whatever, 60% on China, but that does put upward pressure on the dollar. So we've seen that come through already. But obviously what actually happens on the policymaking front is going to be really important.
Fair. And just to be clear, that is speculative at this point in time, right? But Trump did say some of these things.
It depends on how much you bank what he says in an election campaign, and actually even after the election, how much of it's posturing. So there's this theory that he escalates to de-escalate, so it's almost a bargaining chip. So he starts with the worst case outcome for the person he's dealing with, and then rolls back, maybe managing expectations a little bit, but also trying to extract his pound of flesh as well through the process, right? Just to try and get the outcome actually he wants. He doesn't want. I don't believe he wants 60% tariffs on China ad infinitum. But he does want to rebalance the conversation with China on the trade front.
Fair.
having been in the seat in the U.S. government,
You spent a lot of time there, actually, right?
sometime, not a lot. Don't make me sound so old. I've spent a little bit of time,
Yeah.
but there is what you say and what you want to do. But as any president knows, and as any presidential team knows, there's actually a lot of restraint and constraint on your powers. So there's already some debate among some of my former colleagues around, even if you were to do that, like what is the actual law and policy mechanism to implement that? Saying it is one thing, actually making it legal, both in a domestic context, but also defendable in the international context, and WTO as a whole other can of worms. I think what Steve was talking about, I would look at it as, and I don't mean this in any sort of derogatory way, but it's like a micro perspective of what's going on in the last couple weeks. I think it's also helpful to zoom out a bit and talk about the broader narrative around, like, the not macroeconomics, but macro as in like decades and centuries way of looking at currency, as well as the disruption to it, which is technology. And the fact remains at the moment that post World War II, and even sometime before that, the dollar remains the de facto reserve currency in the world. And the dollar is, 58% of FX reserves. It's 50% of trade invoicing. And in Asia, it's actually 75% of trade invoicing. So if you walk into any shop, here in Singapore or any shop in Hong Kong or elsewhere, you ask them for a trade invoice. When they pull it out, most likely is denominated in the dollar and settled in the dollar. And then on top of that, 88% of FX transactions are still denominated in the dollar or done in the dollar. So when you look at that, when you zoom out and look at those big picture, yes, there's the strength of the dollar on any given day or week or hour, depending on what is said or not said, and relative positioning in different countries. But in terms of what people hold as a store of value, as a form of instrument for settling, the dollar remains at the moment the de facto currency. Now, it's not a given that it stays that way. And there are a couple of risks to think about. One of those is actually the United States itself, right? Whether or not the U.S. government, and I mean both the executive branch, but more importantly, the legislative side, raise the debt ceiling and stands behind the credibility of the dollar. That is the biggest risk to whether the dollar remains the reserve currency. Because if Congress doesn't do that and your treasury bills doesn't get paid, it's no longer, quote unquote, the risk-free rate that everyone thinks about, right? So that's one big thing. And the other piece is an area that I'm very interested in is around the technology, which is the dollar as a measurement continues, but how the dollar moves in the economy and as a form of payment, the primitive changes from physical form of papers and coin to digital form, as in a ledger in your bank account, to sitting at your private wallet at a Grab or at a PayPal or what have you. And in this next iteration, which is in the Web3 format, where it's much more diversified, it's more competitive, does the dollar remain the de facto currency in this new format? And I think there is sort of a space race on what the new format of money will be and whether the dollar will still dominate in the world.
Fair. But this question didn't come from nowhere, right? Like people are not starting to talk about where's the future of the US dollar if they're not seeing anything, right? So like, what do you have to say to some of these things that people are talking about? Why is this even a cause of concern today?
If we're zooming out, right, I guess the dollar has an incumbency status, right? So it is where it is. So all the stats that we see, absolutely, it is the number one currency in the world. And is very important. I don't see the debt ceiling as an issue as long as they've got a united Congress, and because then nobody's going to upset the apple cart. Maybe after 2026 we'll be having a different conversation, and maybe it'll be split again, and then you'll get some stress there. Sort of argument against the US dollar losing its status is, what's the alternative? right? So I think, you could say, okay, so obviously there was this big thing that the Chinese renminbi was going to be the currency of the future. And it's clearly making inroads, but it's really at the margin, right? And one of the reasons for that is it has closed capital account, right? So it doesn't freely trade. And so therefore it's not as easy to go there. The obvious currency for me would actually be the euro, but they don't have deep capital markets. Right. So on the equity side, they have different exchanges across the whole country. I guess the US does as well, but they're all linked together better, I think. But probably most importantly, from a central bank reserve perspective, would be a unified bond market. Right. So they're unified by the currency they trade in, but they each trade separately because they're not backed by one unified government. They're backed in BTPs are backed by the Italian government, Bunds by the German government. And people, rightly or wrongly, have a different credit risk attached to each of those entities, right? So, if you're looking at central banks are a major player in this space, if they're looking at reserve management, it's much easier to say, I'll just buy some US treasuries than it is, I want to invest in some bonds in Europe. Okay, do I want to take Italian credit risk or do I want to take German credit risk? It's just a simpler conversation and more liquid, obviously, by extension. Ultimately, I think Europe will probably have to go to a singular government, that actually, so they basically merge all this debt into one, and that could then potentially, but ultimately is maybe not in my career, maybe not even in my lifetime, right?
I think that's a bit of a pipe dream.
So you're going to get into crisis after crisis, right? If you don't do that. I mean, that was the UK's problem with the single currency project. It's like currency union without political union doesn't make sense. And I still think that's as true today as it was in 1999, right? So I think that's why probably the US dollar will remain supreme, because there's no credible alternative for the foreseeable future.
Just to double down there, right? So in some ways, from a retail audience standpoint, we can write off currency risk from that point of view, right? Because at this point in time, it does not look like there's any alternative. So the doomsday scenario is if the US dollar gets dethroned, right? So based on what you've just said, essentially that possibility is very, very low. And you can kind of write it off for another 2 decades.
Yeah, but that's only if you're earning everything in US dollars and you're spending everything in US dollars and you're investing everything in US dollars. Otherwise, you're taking currency risk whether you like it or not, right? So I think that the dollar is still going to be the main denomination of trade and investments, etc. Right? So people generally raise US dollar debt, right? So the Sing dollar bond market is actually fairly small and fairly illiquid. The dollar bond market is very deep, very diversified, very liquid. That's what we're sort of saying. Yeah, you're going to, as a Singaporean investor, if you want to be invested in diversified bonds, then you're taking currency risk.
Okay, fair. Because I think a lot of our audience and listeners, they do invest quite a decent portfolio in the US dollar, right? And that's the main reason why I'm very concerned, because I got a lot of US dollar, right? That's why I want to care, like, where is this going, right? So yeah, you know what I'm saying? Because we're quite invested in the markets.
The one thing I'd say against that, and sorry, I'm zooming in again, right? Sort of more micro, like multi-year. Normally, when the US dollar weakens, asset markets do well. So then you're in an environment where, okay, yes, when I translate it back to my local currency, that might mitigate some of the returns, but you're making more money in US dollars. So when you translate it back, you're still ahead of the game. It's really when the dollar's very strong, when it rallies very strongly, that's actually when the asset markets usually do poorly. So one of the things that we looked at, so we have some funds that we work on with Amundi, and we have the conversation with our Korean clients. I know not totally pertinent here, but it's really, really quite interesting, because you say, so Korean investors generally want to invest overseas on a hedged basis. So it's just the way they do it. Actually, Singapore investors do the same, by the way, not to the extent as Korean investors, but they generally say, I don't want to take the currency risk. But we did this study of saying, okay, if we used just a typical portfolio would have in those funds, global financial crisis, what happened? Well, obviously, equities went through the floor. So the portfolios in dollar terms didn't help, but the Korean won weakened dramatically against the dollar. If you didn't hedge your currency risk, actually, you're basically flat in Korean won terms. but most investors would have hedged that currency risk, and so they were down 40%, right? So they took it, they just got massively hit. So you need to think about how the interplay between the dollar and your portfolio returns to say, should I invest on a currency hedge basis or should I not? It's not necessarily as obvious as people make out.
Interesting. And from your point of view about the technology side of things, right? Because I think there are a few forces attacking it. Although, I mean, China is one thing. There's BRICS. There's the whole Saudi discussion, right? So there's some of these things that are on the internet. There's also that whole crypto growth, right? And recently, I think there's huge growth. So much so that even some of the US people are talking about, whether we can integrate it into part of our thing, right? So like, what is your outlook on this, and how will it affect the US dollar, right?
A couple of things to think about in terms of the critiques of why the dollar will not continue, right? So one of those is the RMB BRICS argument. So I would call that the geopolitical. The second piece that's probably less talked about among your retail audience, but definitely in the geopolitics side, is implementation of it and the negative externalities around U.S. sanctions. So using the dollar as a tool or the banking system as a tool. Yes. That's the second piece. And then the third piece is technology. On the geopolitics side, despite all of the talk around the RMB being a potential replacement, and I think that it makes for really good headlines. If you look at the reserves that countries hold, 58% of those are in dollars. The next one is the euro at 20%. And then after that is the yen at 5.5. The JBP is at less than 5. And the RMB is 2.6. The largest, aside from the euro, is actually the others category. And generally, the others category tends to be gold. If governments are looking for a hedge per se, it's actually not so much in their other peers, but in a physical gold. And we don't have a gold bug here, but I'm sure we can find one next time. And when you look at the data around gold purchases since the global financial crisis, BRICS countries did increase significantly. The largest increase is actually Brazil at 3 times where they are now vis-a-vis where they were in 2018. And then, Russia's and other. And there are good reasons for them to do it. But nonetheless, the majority of the holdings are still in the dollar. Like RMB and others will continue to grow a little bit at a time. But when you look at the picture, it's not what the headlines are saying. It's important to remember it.
I think we have a temporary gold bug in the house, so we're overweight gold. We have a positive view on gold at the moment, right? So
it's done well,
and obviously the central bank story is very important. I think we talk about the biggest risk for the US dollar comes from the US, and I think obviously the sanctioning of the Russian central bank really did create quite a bit of challenges for central banks around the world. So if you're saying I'm part of the non-aligned movement, so I'm not aligned to the US, or I might find myself in that position, then you have 60-70% of your reserves in US dollars. That could potentially create you a challenge, right? So I think there is demand for people to diversify away from the dollar. The problem is gold is still quite a small asset class, right? So you can't sell, $10 trillion of US treasuries and go into gold. That doesn't work that way, right? So if there were other currencies out there saying that we're going to make this easy for you, or there was some digital capability to do that very easily on a scalable size, then obviously I think people would be very, very interested in that. But yeah, we're not there yet.
And the carry cost for gold is, especially at that size, is not insignificant, right?
Yeah.
Like how do you hold and protect?
Well, and some have actually been transporting it, right?
Correct.
So the old joke is basically, the history of gold is basically people digging it out of the ground, shipping it to the Bank of England, and reburying it under the Bank of England, right? Right. So like going, hey, okay, that's an interesting business model, but I think you are seeing people saying, I don't want gold to be located in the UK, some people, because actually the whole point is I'm not reliant on the US or US aligned countries. If I want that gold, I want to have it with me. And I think that's interesting. So it's not just the storage cost, there's also a transportation cost issue as well.
And then, of course, in terms of being able to, the liquidity to the market, like we have to be honest that the current pricing for gold are based on a structure around it being buried in the bottom of the Bank of England. If it's not there, the pricing risk for that gold and the ability to redeem that gold is not the same. Like when you go down, you go deep. There's a lot of stuff that you have to think about, and there are, and to your point around the capital markets, the crypto digital asset side of the world. The fact is that at the moment, when you log into any of the pricing places, the platforms, the exchanges, is denominated in the dollar, right? You could denominate it in Bitcoin, and people have tried to make Bitcoin the like base currency, but you have to be totally living on chain. But like the fact is that outside of a set of crypto bros, no one will take Bitcoin as a payment.
I mean, you could probably use it at some Bali cafe somewhere, right? But that's it.
But no one's pricing their coffee in Bitcoin. They price it in dollars and convert it into Bitcoin. And if Bitcoin prices go up, they're not going to pay you in Bitcoin because they want to hold on to it instead of paying with it. So it breaks some of the fundamentals of like what is money and how is it a store of value that with the stability that you want.
So then how is this crypto boom affecting the US dollar then?
If you think of the quote unquote crypto boom, it's just asset prices increasing, right? And it's happening not just in quote unquote crypto, but it's increasing frankly in all of the capital markets mostly, right? Whether it is in equities, some of the commodities pricing, it's just a risk-on environment. Now, what is intriguing is then, because of that, how much cash and cash equivalent people hold in order to come in and out of trades. And what did they hold that cash in, right? Is it in dollars or something else? Now, I can't speak to traditional capital markets. I'm not an expert there. But at least in the digital asset side, we've seen increase in circulation for stablecoins, right? After the election and the boom of the digital asset market, we started seeing people actually moving more money into things like USDC because they want to be in a position to then move into a risk-on position, whether it's Bitcoin, ETH, or something else, and or to exit out of some other digital asset they have into a digital dollar so that they can move it into a position when they're ready. So that has increased. So for us, for Circle, we saw an increase of a couple billions of circulation coming in as trading pick up. And historically, when there is a bull market, we see higher circulation because it's a form of settlement, and people have to come in and out of it.
Yeah, but it's still tied to the US dollar in that sense, right?
Yeah,
because it's a one-to-one stable coin, right?
Correct.
Yeah.
Right. Properly, regulated stable coins are one-to-one, and it's still the currency.
So
in
they
which
are not properly regulated ones.
There are not.
Okay, we don't go there.
Correct. No. We could go there, and the fact is that not all. I think this is the challenge is that not all stable coins are created equal, and the market have discovered that. Regulators have discovered it. And regulations are coming into place. And as a matter of fact, I think this is one area that we will see in 2025 as regulations come in. There'll be greater clarity, and it actually brings greater consumer protection and investor protection, but also ability for if you have a good base currency to actually support the use of digital assets in the real world.
Okay, fair. So I think we are in quite some consensus about how the US dollars, the strength of the US dollar, and we're riding off a doomsday scenario, right? It's essentially of de-dollarization, right? So I think it's extraordinarily
gradual. Maybe put it like that. It is happening. The dollar is less important than it was 5, 10, 20 years ago, but it's still the number one currency of the world.
Yeah.
And short of a self-inflicted wound by the United States itself.
Yeah, but as we discussed, I think the self-inflicted wound would have to be really, really serious because where would they go, right? They still have to solve for that piece.
Hey, welcome to the Financial Coconut Podcast Network. I'm your host, Reggie, aka your Chief Financial Coconut. And if you're loving what we're creating here, like, share, subscribe, share with your loved ones, comment in the comment section below. And yeah, we'll see you for great content on Chills with TFC. Because I've talked to many analysts, right, in this thing, and I've asked them, similar or questions around the edges. So if we write off this factor, that means in our lifetime, all our portfolios in 20, 30 years, probably this wouldn't be, as crazy, right, from a doomsday scenario standpoint. But if the US dollar comes down from a central bank holding type of situation, right, 50+%, if it comes down to like 40 something, just want to pick your brain. Do you have a model around this, right? Where it is not that a write-off, it's not a de-dollarization scenario, but it's a continuous kind of coming down situation, right? Other than releasing other stable coins, right? Probably you guys have the technology to do all these other things, right? But how would it affect the financial markets?
First of all, the technology, if people were to move into USDC, it doesn't mean that the dollar is held less. If anything else, actually for us, our reserves are treasury bills, reverse repos, and cash. So it's not as if like some of the other stable coins that are in
not so stable coins,
or rather in assets that are not the same as the denominator. I mean, they're taking other side credit risk, tenure risk, other things that we don't do. And we purposely don't do it because it has to be, from our perspective, the safest form of money in the digital form. So even if there are people moving into the digital dollar, doesn't mean the dollar is held less in the banking system. As a matter of fact, it's actually parked in the banking system.
Yeah. I mean, you're the holding, right? Essentially.
Correct.
Right? It's
correct.
a custodian structure.
Format.
Yes.
I think it comes back to Steve's point, which is like, if not the dollar, what else? Right? What else would people want to hold? And if you want to make a play, you would try to buy those before everyone else does. But the fact is that, assuming a somewhat perfect market, by the time you find out, it's a little too late.
Yeah. And maybe coming back to your question, so what does it mean for financial markets? I mean, firstly, I think it's a central scenario that the dollar will become gradually less important. But we don't see it reaching a tipping point of becoming less important than something else. But this is a drip feed over a long time. So there's nobody that I'm aware of that would model that, where people will be modeling much more the short-term cyclical elements of relative interest rates, risk premium, geopolitics, that sort of thing, instead of saying, okay, and the simplest form of that is the dollar smile, right? So if everything's going really, really well, and that means interest rates in the US are going up, the dollar's going to go up. On the opposite side, if things are really, really bad, then the dollar will go up, and in the middle, then the dollar weakens, right? So I think that's the way people generally think about it. Everybody worries about the de-dollarization, but nobody actually does anything about it, at least not in my world, because it's a 20-year phenomenon. It's not a 3, 6, 12-month phenomenon.
Okay, fair.
But I want to draw that out a little more. Like the sense is that when the economies do well, the dollar generally does well. And when there's a crisis, people tend to move into the dollar. So it's that middle area that there's some de-dollarization. And if it's Singaporean, that's like, instead of getting a 99% on your test, is like at 95.
Must a test be in
right? Like, it's still, people are still holding a lot, and there's a little less, but like when there's a crisis, you go back to the dollar, and when there's risk on, you kind of go back to the dollar.
Yeah. Okay, fair. So if that's the case, right, then maybe kind of expound on the shorter near-term type of situation, right? Whether interest rates are coming down, or it looks like it's going to come down, So just kind of, since we're already on this topic, right? Because ultimately, what everybody cares is your portfolio, right? So there's some structural ideas that we've kind of established in the front, but ultimately, people care about like, okay, how is this going to affect my money, right? So maybe from that point of view, can you just kind of expound some thoughts for us?
Maybe look at what a lot of people are saying at the moment, right? So just sort of instead of, and we're not too different from this in the view, but I want to sort of caveat it a little bit, right? Because most people are saying the dollar is going to be up small or down small next year, right? So, and now the question is, I always have when that's the case, is that a high conviction it's not going anywhere? In which case, you can sell volatility on the currency, right? So you can say, okay, and I can make money by doing that. Or is it like going, not sure where it's going, and therefore I'll hold for now until it becomes clearer and I want to take a view, in which case you don't necessarily want to sell volatility because you go, I think it's going somewhere, but I'm not sure which way it's going. Right. I think we're probably in the second category because there's so much uncertainty out there on the policy front. So we've increased our probability that there's a no landing scenario relative to a soft landing scenario. So actually our recession risk is still 20%. That hasn't changed, but we've pivoted from the soft landing more to no landing, i.e. his stimulatory policies are going to be better for the US economy. The US exceptionalism is going to continue, but a lot of that's probably already priced. So what's going to drive the dollar higher from here? It's probably actually the 20% risk, right? You know, that if we have a recession, that would probably lead to it. Otherwise, maybe the dollar just trades in a range and doesn't do anything, at least against the euro and major currencies. Then you sort of look at okay, what's going to happen to the Chinese renminbi, right? And that's the obvious question that everybody is like going, well, yeah, 60% tariffs. One could argue that dollar renminbi will go up a lot, but then you say, okay, what's the dollar renminbi now versus 2016, 2017? It's actually weak already. So our view is actually the downside risks to the renminbi are relatively limited, but there's a lot of risk around that scenario. And how does that feed into Asian currencies is really important. So, you know, we're in the sort of range bound, actually slightly dollar weakness on a 12-month view. But I would say I think the level of conviction in that view today is probably not as high as I would like to be.
Okay, fair. What about you? Any thoughts around? I mean, you guys probably see a lot of flows, so just curious, like what thoughts you have in this space.
Yeah, well, first of all, I'm not an investment guy. If I were, I probably won't be sitting here. I would be sitting in Phuket or Bali in my villa.
Is that what investment people do? No, right?
No, it's retired.
All my investment friends work very hard, It's like, look at
I was
Steve.
thinking you. Right? I think the broader point being that having been on the policy side of things and as an economist, there's a model of how things should work, and there's always a story to explain the should.
Yeah.
But how things actually play out, it's a guess. And some are better at it than others, but it's really hard to be consistent over time.
Okay.
And in particular, even on the policy side, there are general equilibrium models to kind of think through all of this. But the fact of the matter is, it's a dismal science, right? When we're looking at like this Nixon administration coming in, you've got a strong U.S. economy that will likely be stronger given either tax cuts or a stimulus of some sort. Dollars should strengthen. But then you're looking at tariffs that's coming in, inflation, right? There are lots of these factors that, and in the relative positioning of the dollar vis-a-vis not just the RMB, that's one piece, but also the euro and the yen and others. Like, how do we think about that? On the RMB side, Steve was just talking about it from a trade perspective, but more importantly is actually I think the strength of the Chinese economy itself. And if anything, most of the data and most of the action, the interventions over the last decade has been actually propping up the RMB by the PBOC instead of letting it fall. So there's a lot of things that are just unknown, and there a lot of people paid a lot of money to try to figure it out. I think the broader point is, like, as a retail investor, this is a very, very complicated game. And there's a lot of factors that it's really hard to have the right answer, and then to be competing against people who are with much better teams and data. And maybe this is a layup for you to think about.
So look, I think there's 2 points. So maybe on that last point is, what is the most competitive, hardest market to deliver positive returns in? It's FX. My old compliance guy from way back, like 25 years, when he was saying retail investors trading currencies, nobody's rooting for you. If you're buying equities, yeah, there's some mechanism for people to want you to win, right? Whereas in FX, every trade has a loser and winner, right? But I think one of the points I was just thinking about while you're speaking is also, so obviously, even interpreting the past basically plays on our behavioral need to be able to explain things that have happened using simple heuristics, right? So, and then people then apply them to the future, which is obviously is more damaging. But there is one more fly in the ointment of the dollar outlook, right? So, and we're starting to see people saying, we talked about this escalate to de-escalate. Well, one of the theories out there that's starting to, and it's actually in the Financial Times, people saying, well, Besant comes in as Treasury Secretary. What does he want? He wants a weaker dollar. He wants increased competitiveness. Actually, that's what they want, right? They want to bring jobs onshore, right? That's what they want. They can do that through tariffs, or they can do that through a weaker dollar. So they start with the tariff conversation, but then he goes with something, I want some sort of Plaza Accord. I think that's really difficult in this geopolitical environment to engineer, but that's doing the rounds as well. And that's the sort of maybe the downside risk to the dollar. I think it's a fairly, that would be significant downside risk to the dollar.
Yeah.
I think that's a very remote possibility, but it's something that people are starting to talk about, which is quite interesting.
Having been in the Treasury Department, it's a golden rule that the Treasury Secretary never talks down the dollar.
Yeah. Robert Rubin, right? I mean, I was brought up.
Never talk down the dollar. And I think to your point that you talked about the tariffs and other things that could happen. The fact is, it's the growth of the U.S. economy that's going to bring the jobs back.
Yeah. So my challenge is, I don't understand how Trump gets the three things he wants.
Yes.
So he wants jobs to come back to the US, but he doesn't want inflation, and he wants his party to be re-elected. Well, that's because he doesn't want inflation. He wants the party to be re-elected going forward. And you're like going, but you're increasing tariffs, which is inflationary. Well, you're saying you're going to clamp down on immigration. Actually, you say you're going to kick people out of the country. I think that's going to be I think that's really difficult to do, right?
Well, but also very inflationary.
Very inflationary, right? So you say, and he wants to do well in the midterms, which means he needs to keep inflation down. And you're like going, how do I square that circle to policy that actually makes sense? I'm interested, right? I think I did a master's in economics, right? So I'm like going, if they pull that off, that's pretty impressive.
The part that I would debate you on that would be the last, which is winning an election. And you can have relatively low inflation, I guess is not totally deflationary. And you can have a booming economy and jobs coming onshore, which is what has happened under the Biden administration. But somehow he didn't win, or Harris didn't win the election.
Yes, but they had high inflation. They were seen as responsible.
Yes.
They were seen as responsible for, and if you look at real wages, they went down. During the Biden administration, real wages went down. Whether he's right or wrong, I think Trump believes that if that was to happen on his watch, then they'd lose the control of Congress in the midterms. So,
yeah, assuming that people look at the data.
Great. So I think we gotta come back in a few months to have a better discussion around this once he takes over the office, right? So it is what it is, but I'm very happy that we can expound on some of these things, right? So thank you for spending time with us. Once again, appreciate your time. Thank you.
Thank you
so much.